Again, I want to welcome everyone. Thank you for our audience from UK. Again, it's 10 o'clock at night. I really appreciate you staying up, and hopefully it will be a little entertaining. So I won't bore you, and hopefully you can learn something new. And again, welcome to East Coast and Midwest, and our audience in a really warm, sunny California, Southern California day. Talking about hot, as you know, last week, the subject of the week was something that I don't think I've ever seen. And I've talked to some traders who've been around for 50, 60 years. They've been trading and they've never seen anything like this. They've never seen oil dropping to not only to negative territory, but momentarily going to negative almost 37.50. Some people say almost negative $40. And how could that happen? So I thought it would be timely, maybe give you little basic understandings how the futures market work and how commodity like oil works, and then take it from there. So for today, I thought let's review what is the futures market, and then we go to the commodity of the week, which would be crude oil. After that, I'm going to analyze the week that we had, where are we heading, where have we been, and then the next one will be the financial term of the week. I like to introduce one thing every week so you can get familiar with the terminology. I thought we add something new, which is the technical tool of the week. Some of the tools that I use to analyze the markets, the charts, to give me the direction of the market, but also to see if this is a good time to either buy or sell or stay in the market. So we will review that. Every week I like to review a trade of the week that I had, whether it was successful or not. And why did I take that? What was my reasons for that? The last but not least, as you know, I like to introduce one website of the week. I hope the ones that we introduced before, they've been helpful, and hopefully this will give you some other ideas that you can research on your own. So with that in mind, before we even get to the futures market, I like to briefly just talk about the foundation of the economy, and everything that you do depends, majority of the things depend on the supply and demand. And I'm going to tie all this into the futures market and the commodity. So in regards to that, although there's a lot of other factors, but the major factor, whether it's related to gold, oil, currencies, whether it's stocks, could be Apple or Amazon, it all depends. Do we have more supply than demand? Do we have more demand than supplies? Do we have less demand? Do we have less supply? And that's how the price actually and the market come in equilibrium, and they decide at what price it's a fair price at that moment that a price should be offered. It applies to real estate. It applies even in human relationships. So I think before you start anything, whether it's investing or trading, you should have a clear understanding of how the economy works. And the foundation of almost everything is the supply and demand. With that in mind, let's review what is this futures market that you hear. Some of you probably have been trading it, but many of you might not have even had a chance to see what even it means. And I in the past, I've introduced you to FinViz, and I've asked you to look at their futures screen, the futures section of the FinViz, and understand what are these instruments, whether they're financial, whether they are energy, whether they're precious metals, currencies, soft, what are they? And in reality, I'm going to read this. This is more of a academic point of view, but I'm going to explain it hopefully in more of a everyday language. Now, the future exchange or the future market is a central financial exchange where people can trade standardized, which is very important to and I'll explain why. Futures contracts. That is, that it's a contract to buy specific quantities of a commodity or a financial instrument at a specific price with delivery set at a specific time in the future. Now, these types of contracts fall into the category of derivatives. Now, you've heard of derivatives. Options are derivatives. We've had collateral obligations. We've had the futures market. They're all derived from something fundamental, something else. Now, when we talk about counterpart to the futures market is the spot market. That's where the trade occurs immediately with, let's say, with cash, for instance. You give them money, you go to the supermarket, you give it cash, you buy a gallon of milk, for instance. So that's called spot. The futures, on the other hand, is something which is deferred to the future. So it is in the predetermined price. And the future instruments are priced according to the movement of the underlying asset. As I mentioned, it could be stock, it could be physical commodities, indexes, currencies. So these are all, it could be the bonds, fixed income. So that's what really future is. Now, as you know, I'm a history buff. So let's start by when did it start? And then I'll give you some example of what it really means. Now, believe it or not, in ancient Mesopotamia, around like 1750 BC, the sixth Babylonian king, which is most of you probably have heard of, Hammurabi, created one of the first legal codes, which is the Code of Hammurabi, which I will encourage you to read. It's absolutely fascinating writing. In Hammurabi's code, it allowed sales of goods and assets to be delivered for an agreed price at a future date. Now, it required contracts to be in writing and witnessed and allowed assignment of contracts. The code facilitated the first derivatives in the form of forward and futures contract. An active derivative market existed and with trading carried out at temples. Again, these are, if you think about it, now you can bring it back to today and you see we got the Chicago Mercantile Exchange, we got New York Mercantile Exchange, we got London. So these are the places, and it talks about standardized here. You see Hammurabi did that coding then, and it made his exchange to be temples so people will honor their promises. Now we fast forward to almost 3,000 years later, 3,500, and the first modern organized future exchange began in 1710 at the Kojima Rice Exchange in Osaka, Japan. And that's where the farmers, rice farmers, which was the most important commodity that time and still is, that they would come in the exchanges and exchange at the prefixed prices. They would do it. That was like the market that the farmers and the producers and the purchasers or the consumers would come to an agreement. If we notice, in charting, I've talked about candlestick charting. And believe it or not, this is where the candlestick charting, which in the future, I'd like to review that. We might have courses on it on YouTube, what those candlestick means, but this is where it actually started. With that in mind, let me make it a little simplifying, simplify the concept of the futures. I want you to go back, it's like 1800s, and that's where it started with the grain market, like in Chicago. Now, let's say you're a baker or you have a chocolate store, and Valentine is coming, or there's a New Year, or there's a celebration, there's a Chinese weddings are going to happen, Chinese New Year is going to happen, and you need to produce lots of sweets, lots of goodies. You got to bake something, you got to make chocolate. In reality, today is, this is April 25th. And let's say it's the summertime, so it's easier. So there's like 5 months left. Now, you know you're not going to need all that production or the raw material, let's say wheat, the flours, or the chocolate, for instance, today, basically, or the cocoa. Basically, you would know you will need them in 4 or 5 months down the road. Now, let's say for the flour or the wheat, you are the baker and you don't have the place to store all that, and you don't even know. You say, what if the price went up when I wanted, or maybe went down? So why should I buy something, store it, which I could have bought it maybe in a cheaper price in the future? So that's how the exchanges started. This was the original reason. So people, in this case, let's say producers, would come from the providers. So if I'm a baker, I would come to let's say Sean, who's the farmer, and say, Sean, you know what? The wheat is at $5, for instance. Now, let's make an agreement that in order for me to have this stability, so I know what costs I'm gonna produce my cakes, or let's say if it's a cocoa, what price my chocolate will be. So let's have this agreement, the agreement that I'm gonna buy the bushels of wheat, or the pounds or kilograms of flour at this 550. And I want it to be delivered, let's say in December, because that's my busy season. I want to make all those cakes. And Sean says, okay, how much do you want? And I say, I want 1,000 kilogram. Or we come to an agreed upon price and agreed upon delivery time. And at that time, now what happened? We brought stability. So Sean knows, okay, he's going to do hard work. He's going to have a harvest, but he knows that he has a consumer, a customer. So all the work he's done, somebody's going to buy it from him at a predetermined price. Obviously, his risk is, what if there was a drop, or what if there was something and the price really went up? He could have collected a lot more money than, let's say, 550. On the other hand, for the baker, his risk is, or her risk is, what if there was a great raining season, the weather was great, there was lots of wheat, and other farmers were willing to pay, offer him at $4 a bushel, or whatever, say in the flour kilogram. So these are the things. But what happens here, you have two parties come together, and that's what happens. So this is how the futures market, forward markets started. But you fast forward to today, what has happened, it's become more of a hedging instrument rather than actually people delivering the things. So in reality, what it is, it's more of a paper trade. And so you have commercials, and this is a great time to understand, for instance, let's say of Southwest Airline or British Air, they have to have jet fuel. And this is for a year from now, 6 months from now, they have purchased the jet fuel, but they feel that if the jet fuel goes down, well, obviously they can buy it more at the cheaper price, but what if it goes up? So they come and purchase these future, let's say December futures in crude oil. So they say, if the prices go up, although I have to pay higher price, let's say in December, to buy the actual thing, but I can protect myself if the price goes up, because I have these futures contracts. Either they can deliver it to me at that price, or most of the time they don't get delivered. They actually use it as a investment tool, and that's what a lot of these, and we will talk about exchange traded funds. But a lot of these commercials are the biggest investors, but they use it as a hedge. And again, it could be a Nestle of the world, it could be food companies, crafts of the world. And this is how the futures market actually works. So there are 5 elements, the variables you have to understand in futures market. So the first thing is the instrument that we're using. What are we trading? Now, they used to be, believe it or not, people would trade in potatoes, in onions, in eggs, and they're all obsolete, as you know, because of the technology. For instance, eggs, they had their seasonality. Now with the technology, you could have 12 months of the year. Onions actually got outlawed by the Congress, because there were a lot of manipulation by producers of onions. Potatoes, the same thing. We've had a lot of ups and downs, and obviously potatoes have a very finite life. So we've had a lot of commodities in the past that they became obsolete. In 1870s, believe it or not, the fifth largest commodity was the whale oil. It was before we had the actual fossil oil becoming energy, or like for the lights, we actually had people who would go hunt whales and use that. So basically, we've gone to these ebbs and flows, and actually uh, distinction of these commodities. So you have to know what are you trading. So it could be gold, it could be natural gas, it could be cattle, it could be silver, or it could be oil. Now, at how much you are trading for. Again, is this like one contract? Let's say we will talk in oil, which is 1,000 barrels. It's a minimum you can uh, actually trade, or is it 10 contracts, 100 contracts? So you have to, this is what the exchange does. It allows you to understand and have a standardized contract, so you are obligated, and the seller obligated, if you're the buyer, to abide by that contract. Now, what exchange are we using? Now we just have the Chicago, for instance, for the grain. We have Kansas City, we have Minnesota for wheat, and let's say we have corn and soybean. Then we have London metals exchange. So we have Singapore, we have Hong Kong, we have New York, many of them from New York Stock Exchange that we talk about. This is the futures market. You have the Chicago Mercantile Exchange. So you want to see what exchange you're using, so they have that, you abide by that contract. Now, the fourth thing is, remember, we have different dates. So let's say, again, my busy season is, we talked about Valentine is February. Well, I don't need the futures for August, for instance. So I want the delivery, let's say, December. So you have to, in advance, each contract, each vehicle, they have their own month of expiration. And you will see how it works, with which is, we will talk about the commodity of the week, which is the crude oil, how that works. And the last but not least is at what price. As I mentioned, let's say we talked about the wheat at $5.50. So there is, on the exchange, they tell you, listen, in December, oil is being traded at this price. And once you bought it, you're abide by that. Now, the good thing about futures contract is it goes up and down, and you can actually make money on it as it goes up, or you can lose money on it. And that's what futures market become pretty risky. When you started investing, that's not the place to go. Forex, futures, options, these are all leveraged, and basically it's a good faith kind of investments, in the sense that you put a deposit, so you put a small portion and you can control lots of investments by just putting a small down payment. But if the thing goes against you, then you're obligated. You don't have to get the delivery of that commodity before that time, but you're obligated if it goes, you have to cover. And we will talk a little about that, and you will see how it happened in the oil. What happened with again, with this leverage, and how it can break somebody's back if you don't control this. Becomes almost heavy-duty gambling, in a sense that let's say you put the mortgage on the house because you know you have a great bet, and things can go against you. So it's not advisable. This is just, I'm hoping to just to share the foundation of what is the futures. So when you look at it, again, we talked about Finviz, visually you can see how the markets are being directed. And those at futures market are the ones really controlling the actual markets. So because they are looking at the future and see, based on the weather patterns with some supply and demand, what price is the fair price. With that in mind, let's talk about commodity of the week. So what happened on Monday? As you know, again, something happened in crude oil. So what I like to do, I like to explain actually how when you hear about different terminology in crude oil, what those mean. First of all, why crude oil? believe it or not, crude oil was the largest physical commodity in the world. So it's being traded the most than anything else. So it is very important to understand what crude oil is for. With a lot of alternative energy, you can see that the importance might have come down, but the jets are not going to fly with the solar panels, not anytime soon, or the lithium batteries. So we still have a lot of usage for crude oil. The biggest one at this time, this is the gasoline. So that's to fuel cars, trucks, heating oil, diesel fuel, other products. I've came across, I think, over 1,000 uses for in other products, from candles, the waxes. There's a lot of different usage. Lipstick, I mean, you just name it, in the makeup. So there's a lot of usage for derivatives of crude oil. Obviously, jet fuel, which is unfortunately nowadays is not being used much. Propane, residual fuel oil, power factories, fueling large ships, making electricity. And one of the other ones, obviously, is the asphalt, which is the heavy oil. Now, these are the usage of crude oil, but what does that mean when you hear these contracts and they say, oh, Western or WTI, or they say Brent crude, and what are the differences? So in the United States, majority of the trading happens in the crude oil. The price that you saw basically went to minus 37.5. Let's say you heard like USO, exchange traded fund. They use West Texas Intermediate, or the light sweet, which is a grade of the crude oil used as a benchmark, especially in the United States. But it's not the largest. The largest percentage of used crude oil in the world is Brent crude, which is in the North Sea. It goes from Norway to Scotland. When you look at it, it's 66% of the world crude oil is the Brent crude. So I want to stop right here, and you will see there are two different pricing when it comes to WTI and Brent crude. Usually Brent crude is more expensive than WTI. And the reason is Brent crude, because it's offshore, it is from the sea, the transportation is much easier and much more efficient. So a lot of people, a lot of consumers, they'd rather pay for that because it's a lot easier than WTI, which is coming from the shores of Texas, Louisiana, Oklahoma. And that's why it's more expensive for WTI, although it should have the opposite effect. But because of the efficiency, Brent crude is in more demand. The third thing is you've heard is the OPEC, which stands for Organization of Petroleum Exporting Countries. Now, this was an intergovernment of, actually now it's 13. It started in 1960 in Baghdad, Iraq. And there were original 5 members. There was Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. And what they wanted to do, they wanted to actually have a standard pricing and cooperation. And that was it. And in 1965, up till now, it's still in Vienna, Austria. Now, as of 2018, there are 14 members, which they count about 44% of the global oil production, and there's 81.5% of the world's proven oil reserves are in those countries. As of this year, 3 countries left OPEC, or they let the contract expire, which was Qatar, Ecuador, and and Indonesia. Those are the 3 countries that they let their contract expire. But you hear these OPEC, you heard about Saudi Arabia, for instance, fighting with Russia. They wanted to oversupply and they want to pump it up. And there was obviously a lot of political reasons behind it. So with that in mind, let's talk about, you hear this sweet and then this sour, and what does that mean? Now, WTI, which is the Western Texas, it is called sweet and light. Now, the sweet crude oil is the type of, obviously mentioned, petroleum, and it is basically traded. If you recall, we talked about exchanges in New York Mercantile Exchange, and the sweetness comes from that amount of sulfur in 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 the um, in the petroleum. So anything under 0.5% is sweet, and it has this smell. It's a nice smell. It's light, and that's where the sweetness comes from because it has less sulfur. On the other hand, if there is a higher amount, those are called sour crude oil. Now, the high quality, the things that they can be refined a lot easier, they have low sulfur and they are more efficient. And that's why, again, both Brent and WTI, West Texas, they're both sweet and both are light, which will explain what that means. And here you see pleasant smell they have. The sour crude oil, which is mostly in, let's say, Saudi Arabia, Gulf of Mexico, Mexican exports, some of Canadian, they have a high amount of impurity. And because of that, it's a little harder to refine them. So in this case, they're closer to 1 than 0.5. So they are higher amount of sulfur, and that's what they call sour. Now, we also hear that light, it's called sweet and light. Light crude oil is actually liquid petroleum that has a low density. And that density comes from the wax or paraffin. And that paraffin allows, lesser paraffin allows a low viscosity, and it has obviously a lot less gravity. And because of that, what happens is it's easier to transport, and it does have a lot less corrosion too, and because of the low waxes. Now, in a heavy, again, when we talk about heavy crude, you have more wax, and that's what, like Saudi Arabia, it uses the heavy oil that used, let's say, for asphalt. Asphalt is, you can see, is thick, it's heavy, and that's where this most of the usage comes. So again, you can see that it's definitely a lot easier to do refining for gasoline to use sweet crude oil and heavy and sour crude oil. With that in mind, I just want to show, so you will have a copy of the this slide so you can review it yourself. But as you can see, like we've looked at where is the heaviest, where is the most sour. Let's say Mexico's Maya, Saudi Arabia is like very heavy. And then we look at Kuwait in between. But then you come, Iran is in the middle of light and sweet, but it's a little for the heavy side. But this is where the United States WTI is. You can see it's pretty light, and pretty sweet. Now, same thing with North Sea Brent. So we are very close. And then we also have the LLS, which is the Louisiana Light Sweet. This is where Louisiana is. It's not a major, but it still comes from there. And then you can review it yourself. So this is how the grading happens with this oil. Now, what happens with how do we price oil? What is the factors that influence the market price? And these are very important because, like anything else I mentioned, the pricing has to be fair at that moment, fair pricing. And we don't have the crystal ball, but as I mentioned, I want to give you the foundation. I want the fundamental tools so you can project what happens if anything like this happens. Let's say at night you read the news. Is this a temporary thing? Is this a long-term thing? What happened to oil? Why the oil? And I think, Sean, you can correct my memory. I think like in February, we broke below $45 per barrel, which was very, very important. And that was like a warning sign because a lot of countries do need, and a lot of companies in the United States, they really need over $50 of a barrel to survive. So when it broke that 45, that was it for me. And that gave us indication something is happening. And the main thing is supply and demand. We've talked about it. So what was something happened in January, February? Well, the pandemics with COVID-19. On top of that, then we had the OPEC policies, which in Saudi Arabia, by the way, Russia is not part of the OPEC. USA is not part of OPEC, but here is Russia and Saudi Arabia trying to price, fighting with the, reducing the prices. You've heard of petrodollar, which was in 1972, 1973, that when Nixon traveled to Saudi Arabia and actually United Arab Emirates said, we will work with you if you basically work on the dollar currency. So all the majority of the exchanges as far as the commercial usage and the trade is done in dollars. So if the dollar is weak, obviously the price goes higher as you have to give a lot more dollar to get the fixed commodity. When the dollar is strong, it affects the commodities, especially with oil and somewhat gold. The prices go down because the dollar can buy more of the fixed amount of that commodity. Most of you in the United States, we're very familiar with the weather patterns. The hurricanes affect, especially in the Gulf of Mexico, for instance, the production. So that affects the refineries, the war, the terrorism. Now, this was something that if you asked me 6 months ago, a year ago, would have never had it on the list, but pandemics, the government regulations, they can come and say, well, you need this much as far as the purity goes and for the refinery, and state of California is a good example, what they demand. So basically the taxation, so those can affect the supply and demand. Geopolitical factors, let's say in Persian Gulf, the Iranian Navy comes close to American Navy, there's interruption, there's a fear of interruption. The Strait of Hormuz, where almost 25% of the world tankers go, they get threatened. So things like that can affect the price of oil. Then we have refinery fires, we have maintenance shutdown. We had it like 2 or 3 months ago in the state of California, for instance. So, and then the last one is the supply disruptions. Let's say the workers go on strikes and the refineries they don't want to produce more oil. That's these are the explorations. So, and I would put actually even technology nowadays. Really didn't put it here, but you can see how the technology is affecting the price, which goes to the supply and demand. So if you become more efficient, then that affects the price of oil. Earlier I mentioned the countries and companies need that over $50 oil. Besides Russia, which had about 8 years of 8 years of reserves, now it has come down based on what's going on. Russia is the only one which is under $50. Iran needs $52. This is based on IEA, which is the international agency, oil agency. That's energy agency, I mean IEA. Is that based on their numbers, Iran needs a $52 oil, Iraq 54, United Arab Emirates 67, Saudi Arabia 84, and a country like Nigeria needs $127 of oil. This is an example of, and this will tell you what happened on Monday. So if you recall, I mentioned the futures market. The futures market looks at the future and the price the oil in this case accordingly. So what you saw on Monday, the May contract was expiring, and that was on Tuesday. So they had to deliver because some people still owned it. They couldn't believe that, you know, that the oil is going so much down. They were hoping it will turn around and they can sell it. And it kept going down. Now, the problem has been for these, again, we talked about the supply. With pandemics, obviously, the world economy has kind of standstill, so there's not much demand. If you don't have the cruise liners, the trading, the flying, the jetliners are not using, people are not driving to go to work, obviously the demand is low. Now, on the other hand, the supply has been, and it actually happened from 2016 and on, we've had just oversupply. And what has happened, the companies and the countries, they need to produce because they need revenues at any cost. So what happened was people were hoping the price will turn around, and it never did. So a few weeks ago, I mentioned the storage has become a big uh, a, a big problem for these oil refineries and oil producers, because in the United States you have Cushing, Oklahoma, which allows certain amount of storage. And then we've been having these tankers which are just floating around and they're full. So when you have this amount of oil, I am still producing. So what happens as a well, if I stop, it's a lot more expensive to restart it again, because mechanically it's difficult to start, but also it could be damaged. That well could be damaged. So it's a lot more cost effective for me to produce. Just that's what the supply keeps adding up. The problem is I don't have anywhere to store it. So here it's Monday. The prices have gone down so low and I'm still producing. So what happens here, I am giving you, and I'm saying that you can take this for nothing. Or actually, I'm going to pay you. If you take off my hand, I pay you money. And that's how the negativity comes. That's why the producers are paying the customers, saying that, listen, just store it somewhere. And that's how that money went down to $37. Also, USO, which is Exchange Trade, the largest trade fund, which works on futures, had an expiration of the roll-it. So what they do, they own near the month that, which is the closest month. For instance, we are in June. So it's June 20th. It closed on Friday at $17.18. So that means that's the price of oil for the month of June. And you can see the heaviest volume, we call that front month. So that's the closest month to you, it's front month. And it is a 596,000. That was the volume of the number of the contracts. So USO owned the May contracts and they had to roll it over to this. And what they did, they kind of skipped that and they came with the new rules, USO, and we will explain that how that works. They were supposed to own majority of them in June. Now they're buying July and August. So basically, you can see because of that storage problem, you have to pay a lot more for the futures contract because you have to store that if you want that to be delivered in November. So technically it's called contango. Contango means that the price of the next month is more expensive than this month. So basically, if you go to December or January, you can see you're almost at $30. That doesn't mean we are all really just positive everything's going to go away. It's mostly because of the storage problem. So someone bought, there were people who bought at 50 cents. Someone's bought at 1 cent, thinking that, listen, how could oil go to minus? The worst case is going to go to zero, like a bankruptcy, right? So you buy a stock is at 100. What is the worst case is my $100, I'm going to lose it. Futures market don't work that way because you have a leverage. And because of, again, you put, let's say, $1,000 or $10,000, you could owe millions of dollars because of, again, the leverage that you have. So, but I will explain how that works. It's, in this case, because of that negativity, really you have to pay millions of dollars. Now, this is not the first time, by the way, we've had negative in commodities. In some of the good examples are negative interest rates. Now, majority of the Western European countries and Japan for the longest time, they've been offering negative yield. What that means is that you have to pay the bank to hold your money. So you not only don't make any interest, you actually have to pay them. So, and the reason is the security. We feel confident. If I have $1 million, I don't want to hide it under mattress. So I'd rather pay the bank and not get anything. And that's where it goes with the safety of the the currency and the safety of the institutions or the country. And that's why the dollar is the go-to currency, because people feel, even though fundamentally there's a lot of problems, it is the most uh, uh, solid and accountable currency around the world. So the money comes here. And also another reason is we still have kind of positive, they don't have a negative yield, so the money still looks for the best yield when it comes to the United States. Now, when we talk about futures contract, this might give you indication how we could invest in it. In a futures market and how to invest in oil, you can use the symbol is CL, and that's again that's for the Brent WTI in the United States. So what happens? One contract in CL, the futures market, represents 1,000 barrels of oil. So here, if the oil moves up $1, my contract moves $1,000. Every movement of a penny, 1 cent, represents $10. So imagine my $1,000 can control $1 million. I mean, that's the amazing things about the leverage and the margins, but it can go the other way too. And that's what, again, it's a risky business, but if you know your, again, risk management, money management, and you're familiar, it can be a very lucrative investing tool. So that's one way of investing in oil if you wanted to. The second and probably the most popular one is using exchange traded products, which is the most famous ones is exchange traded funds, which are ETFs. ETNs are the exchange traded notes. So you, in reality, with notes, you don't really own it. You have your fate. It's like I owe you kind of a paper. You give it. Barclays issues this oil contract, and they give you a piece of paper. They say if anything goes wrong, they're going to pay you based on the price. ETFs actually own it, and that's what it comes, and that's what USO, which is the largest, it actually owns not the physical, but owns futures. And what happens is the price of USO just completely got demolished on not only on Monday, but Tuesday, because what happened here, the contract, they had to come and buy a more expensive future contract. You notice that we had contango. We were going, June was more expensive, July than August. And they completely changed the whole philosophy, and they came out, it's just a couple of days ago, so, oh, we're gonna own 40% in month of July, 20% in August. But initially their policy was saying they're gonna own all of it in the front month. So they got hit harder, the hardest of all the other ETFs, and they still gonna pay the price because there's a lot of leverage. And so I don't see oil being out of trouble for now. I mean, things look good. When we've had like 2 days, you will see in the charts, but basically we are not out of woods. So these are like oil, DBO, BNO is the Brent oil rather than WTI. Or if you want to invest in actually energy sector, the companies who produce, they transport, they do refinery, the explorations, the piping, you can invest in XLE, XOP, OIH, and these are the alternatives that you could have. Obviously, one of the alternatives is actually buying oil companies in a different capacities. These are the major oil integrated oil companies: Exxon, British Petroleum, Ecopetrol, Chevron. Then you could have like Apaches of the world, the ones that do the wells, the ones that lease the land. There's so many other alternatives that I have shared with you in the FinViz classes we've had, but I'll be happy in the future to talk about it. The other options, you can use options, which is the derivatives. You can buy options on ETFs, you can buy options on futures, on crude oil, you can buy options on individual stocks. So your risk is really limited. When you buy an option, basically you know exactly how much you're risking. This never goes negative unless you sell an option. When you're buying it, you have the right to cancel anytime and just collect your money. So basically, options are a very risk-averse kind of way. Although a lot of people think it's a risky vehicle, I think you have a lot of strategies using options. This is the latest on the USO. On April 22nd, USCF, which is a mother company of the USO, announced today that it will execute a 1-for-8 reverse share split. And what does that mean? What does that mean is if like one share of USO is at $2.50, or let's say you own, let's make it a lot easier. So let's say you own 64 shares of USO, and it's at $2.50. You wake up on April 28th, on the 29th actually. Now instead of owning 64, you own 8. So basically they reversed it. So they give you less shares, but then they increase the price from $2.50 to $20, or depending on what the price is on April 28th. So in reality, your market price hasn't changed, the total whatever investment. What it is, a lot of exchange traded funds have to do that because these funds are, when it's in the futures market, these are a wasting asset. Because of these rollings and other things, the prices keep going down. So they constantly do this. Now you will see this a lot in the volatility indexes like the VXX and VIXI and VXZ and TVIX, and because they keep going down, or like an inverse for like the, let's say QQQ, you have QID, and these, because they are rolling constantly, then they go down so much that they lose their value. They go to pennies. So in order to keep the activities going, they need to do this reverse. Now, on the other hand, the main thing up to before these ETFs and all things, you used to have just a split. Exxon was famous for that. Boeing used to do that. Imagine Amazon is up to $2,400. Now, if you're a shareholder, that's great. But if, let's say, you only got $1,000, can you buy a share of Amazon at $2,400? Although there's a talks, there's a places that you could buy portion of share, but for simplicity, well, you cannot buy. One share is $2,400. So a lot of these large companies, they used to do split to bring more, obviously, investors to their stock. So let's say that they would do a 10 split for Amazon. So instead of paying $2,400, now your shares are at $240. Microsoft was famous for that. I mean, Cisco. So there are a lot of companies, especially in the 1990s, there were a lot of technology companies used to do that. All right. Checking the time, so I got a lot to go. So it's like the market analysis. Again, I'm going to be quick at this because I'm trying to give you the tools, so hopefully you can have understanding how things are working. But with markets last week was really, if you look at it, it was more of a standstill. And once we get to the charts, you will see how things are happening. We have a tale of two markets in reality, two economies in reality. On one side, notice Georgia says, we're going to open. We're going to have bowling alleys, some restaurants, the beauticians, you can have limited. And places like California and New York, they're still very hesitant. So my hope and wish, as I know most or all of you are, we want this to go behind us. The problem is it's a health issue and it's so unknown. Although companies are working on this, there's a lot of promising news coming, but it's a lengthy process. You can see how Gilead comes with one. Somebody says they got the notes. It goes up last Thursday, comes down this Monday, Tuesday, goes up again on Friday. So, oh no, we do have some promising. I know there's a lot of, again, some companies, Glaxo, Johnson & Johnson. I mean, there are companies who are working hard at this, but the problem is the unknown. So the markets are a discounting mechanism, right? They look at 6 months, 8 months. So right now, if you notice from the bottom, some of the markets have come up. S&P, you look at, they are up about 30 some percent. We've dropped 30 to a 33%. We are up about 35%. So the markets are coming, that they have gone up. But the reality is this based on hope or is based on reality? So what I'm going to do, I'm just going to offer a few ideas, let you decide. And I tell you some of my thoughts, but this is again the tools for you. So we are looking at the economies, we are looking at the financial situation, and then we look at the health. Now, some of the first victims of this economy were airlines, energy sector, cruise operators, restaurants, private equities, believe it or not, hotel and travel industry, retail chains, and real estate. So the question you have to ask, are you an investor? Are you a trader? If you're a trader, which you look at very short term, and this has been, I have to admit, it's been a wonderful environment for trading, because really you don't care, it goes up and down. As long as you see the confirmations and you think you're not gonna look at things 3 months down the road, this is for now, that's fine. But if you're an investor, this is the question you have to ask yourself. If you're a long-term investor, 5 years down the road, when you look back, was this a buying opportunity? If it is, then I would gradually start investing. If it's 3 years down the road, you feel the damage which was done, it was a one-time because of the health and nothing else, economy that I mentioned again last time, don't fight the central banks, don't fight the governments. If this is the case, then maybe this is the time to start investing gradually. Not all at once, there's gotta be cautious. In my opinion, I think the longer this goes, obviously, the more problems we will have in many ways. And if you notice, there's a lot of what we have, these are very much economic sensitive. You don't see the technology. There's a different world has been born out of this, I think. And I think they're kind of restructuring our whole behavior. And it starts on Zoom right now with just that digital education side of things. The people's behavior is going to change. And you have to ask yourself, how much traveling will I do? Or I would be very comfortable to go back in a month. What about, would I feel comfortable going back to the restaurants? Or, you know what, this homemade meals, mom, dad, or in our case, my daughter and my son, they did a fantastic job this week, made the greatest meals. It was finest things that I had experienced. So maybe eating at home is not that bad. We don't have to have this fast food all the time. How about hotel industry? Maybe you're gonna travel less or maybe drive more. And that's one thing I would recommend. I mean, that's why like the gasoline, investing in gasoline might not be a bad idea if things get back to normal, rather than jet fuel, for instance. So is this a good time? Retail chains, just look at Amazon and JCPenney, Macy's, even Nordstrom's. Look at, are we gonna be going to the malls for shopping? And real estate has been affected in different way. And I think we will have, just as maybe in the future, we'll be to talk about real estate because it's a very big factor in our economy. It's a much larger market than stock or equity market. Let me just share, I've told you about history. I love looking at the history. I went back, looking at, this was done with the Favor Analytics. We looked at what central banks rate movements in 31 countries and how much in average they would change the rates in all the accumulative countries. You can see, the average usually been about under 10. That must be 15. The only time was in 2008, 2009 financial crisis, they were 30, and look where we are now. So I'm looking at the fundamentally what is happening in these countries. The name of the countries are down here, so if you're ever interested. I'm also looking at, last week, if you recall, we looked at the components of GDP. And if you recall, 70% of GDP is consumer consumption. And not only that, about 45% is actually in the service industry. If you notice, the industries that got hit hardest, majority of them are service industry. So these are the food for thought. This is where we were right in February. This is where we are, the last number, the 71. Now, this is a question you should ask. Do the people, the consumers are ready to go back and start spending money, or they still have the uncertainty about their future, their work? We went over 22 to 24 million unemployment, which is the greatest since Great Depression. My hope is it's enough of injection of the government money that it will help, but I can't help see that there's going to be business already. They're obsolete. They close their doors. The hope is this is just changing. There was old saying, the new economy, new economy. This hopefully is like new industries are being born. Because I don't want to see what happened in the past. And hopefully we will avoid that. And as you can see, every time we had such a low readings like in 60, that's when the recessions happened. And again, this goes back to 1991. And I also want to share again, these are the unemployment, the last as of my birthday, April 24, the numbers came out. So this is state by state, what is the unemployment rates. So hopefully again, there is a immigration in a sense of movement from one industry to another. And this is by the US Department of Labor. And let's say we did, everything is back to normal, we are back to work, but psychologically, do we have damages done in a sense of our thinking? My hope is not, as a human, we have recency effect. The things that happen the latest stays with us most, and that's what I think we don't learn from history. And it is important. So right now, this is the reason people are very much thinking about what happened in the past 5 weeks. So this is their answer. So hopefully maybe a month from now, hopefully with the testing that Georgia is doing, opening doors, some smaller states are gonna test opening by April 30th, May 1st, limited access. My concern is the big urban areas, but I mean the big cities such as like New York City or LA or Chicago, those are the big concerns, and those are the big areas that we want to see if things are working. So New York is not ready. California is definitely not ready yet. They're still studying what's going to happen. There are some states, I know Maryland is not, it's Minnesota gradually started doing it, Michigan, not yet. So May 15th is the time average. I looked at the 50 states. Looks like May 15th is the average time in that 3 phases. But at this moment, this is the CBS News poll, and they asked if you stay-at-home restrictions were lifted right now, would you be comfortable? And you can see to go to bar or restaurant, 75% no. On an airplane, to go on the plane was bad enough with the air, circulating, and you used to get sick. I mean, I remember we were just having a dry throat. Imagine now. I mean, that's a question. So how long these airplanes are going to last? Or, which is it's important, discretionary, a large event, sports and other things. I mean, this is America. And, this is very important also to know that in America, we have never seen this. We have never been restricted Now, I compare that to some of developing countries and emerging countries. The government most of the time is in total control. So a lot of people from that country or those economies, they are kind of used to listening to their governments, and this is not something really new to them. In America, we are not. In Western Europe, we are not really. Um, Obviously, in Western Europe, they have tasted the World War II, which we really didn't as much because we were never invaded. So they have some type of, I mean, our great grandparents or grandparents, they have tasted it, but we don't. So this is completely unknown for us. So there's a natural fear going on. But I'm hoping there's these vaccination, hopefully when they come, they might do it every year, every 2 years, who knows? But I'm just hoping it will be sooner than later. So based on that, so this is a study was done, it was Bloomberg had a hand in this. So they looked at what happened in China. Oh, that's Goldman Sachs, sorry, Goldman Sachs. And so what happened when they had the drop as far as consumers, they're going back to the consumption. So you can see the bottom was in beginning of February, they were over -70, and now like close to -20. So this is a nice trend. And this is where we are. This is as of April 16, 17. So this is where we are, back to where they were. The hope is we will go back. The only issue I have is, again, these are the numbers from China. So I'm not sure how much of this activity is true, but let's give the benefit of doubt and let's hope this is how it's going to work out. Another thing, I look at the charts, basically, I'm an advocate of, I don't think the markets I don't believe we are in a V-shaped market rebound. I have my reasons, and I've talked a few of those in the past. Although, like last week, looks like, as I said, there's a tale of two markets, and I will show you in the chart. Some people saying, well, we don't have to have, we already had our double bottom. If you recall, that was part of our technical analysis. We talked about we'd like to come down and then go and kiss it again and then rebound. So there was talked about these take 65 weeks apart. We did it from June 10th to October 11th. There was a double bottom. Then October 14th to February, should be 16 actually. So sorry about that. That's February 16th. This is wrongly done. But that's 68 weeks. We got double bottom. Now in December 18th, if you recall, that was when Chairman Powell had a big talk, and we went and we visited that. So basically that was a V shape. I explained to you why, because immediately they reversed the course. I don't see that. This was not like a one-time thing. This is going to take some time, in my opinion, to digest. It's not going to go have a V bottom immediately. W immediately. It will take some time, which I will show you in the charts. But there is some economic damage done here that it was not done there. And this was not global, and this is very much interdependence global. But again, that's my thing. So sometimes charts, we can make this, read the book the way we want to read it. So, and it all depends. I was telling my daughter in 1972 or 75, I don't know when it was, the Exorcist movie came. And that was like, I think the most horrifying movie made. It was, and I remember I went with my cousins and my uncle, and we're sitting there, and we're just laughing. So our perception was, wow, this is so funny, and like everybody's like scared to see. So the question is, who is looking at the picture, basically? I've talked about this before last time I mentioned. So this is, I went back to the internet bubble, and you can see S&P 500 is even more concentrated than we were in 2000. We had Microsoft, GE, Cisco, Intel, and Walmart. They actually were about 18%. Today we have Microsoft, Apple, Amazon, Google, and Facebook, they're actually 21%. So 21% of our index is driven by 5 stocks, which are, they're really, if you look at most of it, they're like really new economy, digital, technology. So Amazon movements is obviously helping. And that's what I said, we have a two-tail of markets and economy. Now, on top of that, icing on the cake, this week, exactly the companies that I mentioned, they're all coming with their earnings. Besides Monday, you can see Tuesday you have Google or Alphabet, Microsoft, Facebook. Thursday, Apple, Amazon. Now you have to think, are these going to move the markets? In which way? These are the time to put your analytical hat and say, no, Google obviously decided to cut 50% of their marketing budget. Our people, majority of their, really, believe it or not, a lot of airline or the travel, discount travel agencies, and they were the biggest, or booking agencies were the biggest, one of the biggest consumers. Do they have the budget right now? So these are the things talking about Google, about as their revenue comes from marketing, right? Microsoft was smart enough, and they moved from being a mature company to a growth company again. Now we have iCloud, and Facebook obviously last week comes and tries to compete with Zoom. So Facebook is trying to stay ahead of the game. Apple, we'll see what happens. And then Amazon is its own world. So I mentioned before, and then Friday, Berkshire Hathaway and Exxon. It'll be a little quicker. Don't mind, I know you have time, it's limited. So this week I thought to talk about a little more of a technical, which is called financial term of the week. And I'm going to talk about, there was a question last week, when do we sell? And I mentioned the tools that I would use. It was a fundamental. If there's a disappointing earnings, was the objection was like maybe they didn't have they were counting on, let's say, a trial and it didn't go the right way with the medical companies, or the sales slowed down, or the CEO or the management was changed. So those are fundamental reasons it should give you. Then we talked about the sentimental, we talked about the money management, which is very important, the risk management, and then also the technical tool. One of the tools that I use is something called average true range, which is ATR to abbreviate it, is a technical analysis indicator that it measures the market volatility. What it does, it looks back on the asset price. In this case, most of the time, they go back 14 days or 10 days. And they say, what this asset, how high did it go? How low did it go? And then they average it out. So basically, they give you a band to tell you, all right, this company, and I'll give you right here. This is a chart of Apple as of yesterday, which you can see it's against their trend line, by the way. So this, the ATR for this, when you go to Finviz, you type in Apple, and I will show once finished, I will go to Finviz to actually physically show you this. It's the movement for the past 14 days was $10.88 a day, right? So it averaged out. So if I'm going to use that as a selling instrument, I say, okay, I bought it. I know it's going to move about 68% of the time, it's going to move about $10.88 up or down. But what if I see that it moved more than that? That means there's something, the sellers really are in control. And let's say it would move double that, which is, it's not really standard deviation, but it's a 2 ATR, which is about 90 to 95% of time, it stays within that range. So let's say instead of, if it went down more than, let's say, $24, which is double this, then there's something wrong, and I'm gonna sell it. So this becomes a technical tool that you can actually look at the normalcy of the movement of the could be commodities, future, I mean, any investment vehicle, currencies, by using this ATR. So ATR is right here, and once we have time, once I finish, I'm gonna go to Finviz and show you how to do this. And based on that, you can set up your own exits, your buys, your targets. You say, boy, if it moved another $20, I'm happy moving out of this, let's say Apple. With that in mind, then I said, how about if we use the technical tool based on ATR, which it is called Keltner channel. And what it is, it's a moving average band. And what it does, it uses a 20-day, this is if you're using daily, moving average, and it goes up and down, uses those ATRs. So it moves twice that. So you know there's a band. And now visually you can see, okay, this is a 20-day moving average. It moved twice. Let's say we talked about Apple, $10 times to $20. Okay, this is upper band. This is lower band. Usually the price either stays there, or if it's trending and it's like moving on the upper band, that means there's somebody knows something. That means there's more buying coming in. So I'm going to stay in this. I'm not going to get out. If it was the opposite, then somebody knows this is going down, so I'm going to get out. So what I like to do, I want to give you some examples on this. And at the end, once we're done, I'm gonna go to stock charts. This is part of our website, stockcharts.com, that I will actually walk you through it, how to set this up. But for now, and I will talk, I'm gonna do two operations at one time. One, I'm gonna talk about the Keltner channel and also the tail of the two markets. Now, this is the NASDAQ composite. What is NASDAQ composite? It's mainly technology. Many innovative companies are in this. It could be the biotech companies. Majority of, again, the cloud companies. The biggest holders, holdings are Microsoft, Apple, Amazon. We talked about Facebook. You can see, once we dropped all the way back here, March 23rd, we not only went over our 20-day moving average, we've gone over our 200 moving average. Now, this is the 20-day moving average. It's a simple. So that means every day is equally spread and it's counted. And once we moved over this, we continued. We are back here. We are really almost back where we were in almost December. This is amazing how the markets have moved up. Now, this is the upper band of our Keltner. This is the lower band. So how do we read that? So how it's going to help us to analyze our holdings. Number one, this moving average, you can see, is sloping upwards, right? So because it's going up, that means in an up move trend. So the trend is telling us the buyers are in control. So as long as the buyers are in control, when this movement moves over Keltner channel, it continues. We are not sellers because we know we want to stay with the trend. And let's see what happened here. We were overextended, which is fine, but then the moving average is sloped downward. What that means the trend has changed. And now the lower band, the minute we went outside this lower band, that was our warning sign saying that something bigger is going to happen. Usually when it continues, it goes down when the slope has changed. And guess what happened? So this was one confirmation that something is going on. Now where we are, as you could see, now the 20-day moving average flattened, and then now we are moving upward. So we're gonna go up here, and if we move outside of it, that doesn't mean we have to sell. That means if this slope goes up. Now we are in a very critical time because there's a lot of resistance right around here, but the movement now, the trend has changed for the technology side. So just remember this again. You're going to have all the slides so you can study it. Now, these three things are called indicators. They're called oscillators. They tell us the momentum. We will talk about those in the future. So there's RSI, MACD, and stochastics. Stochastics, when it's over 80, that means overbought, but that doesn't mean you have to sell, because it can stay overbought and still go up. The minute that it turns, that comes down, the same thing that the MACD comes down, that gives you heads up that now there's a selling going on. So you can see the confirmation on all three of this. Let me go quicker. So now I compare that to S&P 500, which still has technology stocks, but not as much. It has financial and some energy. So you could see the same story, but right now our slope is not as big. But again, we've broken over the 20-day moving average. We just broke over 50-day. So we'll see what happens this week. If it does break this and keeps going, this is our next big resistance. That's the 200-day moving average, which is at 3,000. So S&P looks okay, again, because of those I mentioned to you, big components. Is that a real indication of what the markets are doing? I don't think so. But again, this is what the market. So if you want to play SPY, maybe you could be long on this one, which is this SPY. SPY, there's the ETF for the S&P 500. Maybe you can buy it and buy maybe even options on it. But let's continue. But look at what happens with the Dow Jones Industrial, which is the 30 components of it, which is a major industrial and financial companies. We have broken, but the slope is pretty flat, but we are not, we are just close to that 50-day moving average. And again, the things we were actually had sold. So this is a lagging. So let's say this is the average. So we had two markets going up really nicely. One is kind of flat in a sense, still have resistance. It's not even at 50% of its retracement. But let's look at transportation, which is the heart of any economy. What you see here is really it's a flattening. So basically this moving average, you can see it's flat. So current channels, when the market is flat, they actually give you this resistance and support. So when the market is, that this is going sideways, then if it goes down to 7,300 or so, usually that's a good time maybe to buy. That means it's kind of oversold. If it goes over here, that's a good time to sell. So that's how curtain channel gives you a channel, a band to actually give you a little indication of when is a good time to sell, when is time to buy. This again, you could see we were really flat, and immediately once we broke below that, we never even went back inside the band till we got, again, we got confirmation here, we got confirmation here, we broke over the band, and then we came and kissed that part, and then we went up. So this is my other tail of the market, which is economic sensitive. The same thing with small stocks. You can see we are flat again. So, and we have a high volume when the things are that, while they're flat. So the smaller stocks are not keeping up with the technology side or the 100 of technology, the NASDAQ. IWM is a Russell 2000, which is a 2000 small stocks. And again, we are flat. So we're still nowhere close to that 50-day moving average. On top of that, you can see the gold, which I'm gonna, it has been in the past, we talked about the economy, how it's get affected in the past when the 2008, 2009, and we go back in the history, Great Depression, but then we moved up in 2008, 2009. You can see gold was the biggest winner at that time, and it's been one of the very few assets which is in the positive right now. And again, you can see we went outside, came back, we just hit that 20-day simple, and we bounced back. So as long as we are over that 20-day, we are in the upward movement and stochastics is moving up. So it's a kind of a neutral to positive. The dollar, the same story. The dollar is important because that's what indicates the price of commodities, as well as what is the confidence in the United States economy, but as well as the risk. So when there's a risk in the markets, money goes to the dollar. And you can see we're still above the 20-day, and we are flattening, but still it's in the up movement. Every time we hit the 50-day, we bounced back. But I will watch the dollar. One of the things, again, I'll give you these in the slides, so you could actually do it yourself. It's free charts on, on stockcharts.com. So I'll go quicker. Time is the oil. This is the symbol for the light crude oil that the Western Texas. You can see this was at the day we went negative. We bounced back, but I would not touch it. We are under the 20-day. This is in a downward movement. I would be pretty hesitant playing the oil because I still don't know if we're going to have a deleveraging with a lot of traded funds, and what's going to happen with the energy stocks. USO, we talked about that. Look what happened. We've been below that 20-day. It was almost 11.10, and we're at 257, and it's not going to get better, I don't believe so. XLE is a symbol for energy stocks. The minute we went inside the band, we've continued, so we are getting toward that resistance, which is the 50-day moving average. XLF, which is the financials, which was very important again. So again, tale of two markets, right? Financials are the backbone. Real estate is the backbone. Talk about the small caps. They're not doing very well. Now we are flat, but yet you have SPY for the S&P 500, and we've got the NASDAQ that are moving up. So again, I would play the market again cautiously. I kept saying, Berkshire Hathaway. And then speaking of that, in the history I showed you last week, for instance, the news, the articles about what is Berkshire Hathaway is doing. Have you noticed Warren Buffett and Charles Munger? They're very quiet. They haven't said, "Oh, we're going to come in and keep, there's a lot of opportunities if we want to buy this." So those are the things give me hesitation. EFA is anything outside the United States, stands for Europe, Far East, and Australia. Flat again. Overseas, we haven't gone anywhere since really the first week of March when the whole thing moved up, and then the movement in oil, and then the Fed came, but pretty flat. Emerging markets, again, they're pretty flat. And I thought icing on the cake is the Apple, how to use this again. You can see kind of flat, so this resistance could be 291, but also showed you the trend line. Amazon, the same thing. We've been, it's a beast. It's gone over the span, but we are getting a little tired here. One of the reasons, obviously, they're waiting for the earnings coming up on Thursday, so they want to see what's going to happen. We still, although we are overbought, but still we are not turned the corner to have a sell signal. And the good sign is, the bands are moving upward. Shortly, just quickly, the trade of the week. Monday, as you know, we had that big sell-off for the afternoon, about 11 o'clock. I bought heavy, the S&P, the Spiders, June 19 put at 260, and it was in the money. And basically, the reason I want to show you is not like, oh, it's great or not great, is I just want my mentality. I saw an opportunity that the market was selling on a high volume at that time. And if you notice, I covered about 15 contracts, but it just kept covering, selling till the next day. And I had 15. The 14th one was sold before, I think it was like before 7:30 or so. So basically, I only have one. I'm down $21 on this. But the average, again, you have to stick with your discipline, your trading guides, you plan your trade, you have to plan your trade and then trade that plan. So my thing, I don't have regret. I don't go back. If I lost money, I learned from it. And as I mentioned before, if you lose money, you just say, market, I gave you a loan. I'm gonna take it back from you. It's just a matter of time. So have that mentality, but don't have regrets. If this is, and have your discipline. I like to get out when it's at 25%, I get out. And then I have less at risk. But the average return was about 50%. So the best was like about 65%. So I still have one. This is a June. I just use it as a hedge for now. You can see this is where I sold, and this is as of Friday. So I wasn't greedy in the sense, oh, I wish I would have sold it here, or I can't wait. It's going to go much higher. I want to have my 200% or whatever. No, and I'm down to $21. The last but not least, every week I give you a website of the week. I hope you visit these. Again, my two favorites are FinViz and stock charts. This week I thought, since we're talking about futures, commodities, CMAgroup.com is fantastic. It's anything you want to know about commodities, about futures, how the contracts are sold, even if they're difficult sometimes to understand, just have it available. Maybe 6 months down the road, 3 months down the road, it will make a lot more sense. But it is available, it's free, a lot of good education. So with that in mind, I think this is it. I'll exit this. It's about 3:33. I want to share something with you again on FinViz. So Sean, if it's okay, I'll speak maybe for another 5 minutes, just share these, and then we can open for the questions.
Sure, of course.
Okay, great. I know time is of limit. We have to finish by 4. So I mentioned to you, so now I'm hoping by looking at, when you go to FinViz, so this is the home, you open FinViz, it gives you all the nice information, look at what happened on Friday, oh goody, and then you look at the map of all the stocks, you see Microsoft and Google, how they did, and then it gives you what is upcoming, let's say on Monday, what is the companies coming before the market opens, after the market opens. So let's go to the futures, and basically, now you look at it's color coordinated, right? So basically this is your energies, this is your indexes. So obviously the lighter the color, the higher the movements, but just right off bat, you can see that it's getting really flat on S&P, it's getting a little tired. The gold needs a rest. So what I want to show you is 2 things. Number one, every morning, and you can do it over the weekend, just look at the chart. That's it. That's all I want. Don't have to understand everything. I want your eyes to get familiar visually with what is happening. Is this understandable? If I put my, if I had a 5-year-old son, or is a 5-year-old can see what is going on? Oh, we had a big drop. What is going on, Dad? I can see, oh, it's like flat. Here is S&P is going up, again, flat, and NASDAQ has the nicest of them, but this is if you break this high of that candle, then you have to be bullish, because then the distance is much higher to come down. Here, the distance is much lower. Look at Russell. We haven't gone any distance. We had 38.2% retracement. So it's a lot easier for the small caps to break down. So maybe you can be long NASDAQ 100 and sell or buy puts on Russell 2000. I don't know. So I don't want to go too much. I know again the time. So this is number one. Basically, the Sundays, Saturdays, take a look at that. And let me go to Apple because I had, so this is Apple chart. And as I mentioned to you, is every week I like to give one of the things that, so you can see you put the ATR and it tells you it's called average true range. And then it tells you 14. That means it's for the past 14 days, Apple has moved $10.88 up or down in average. So I can do the same thing with spider, and you can have the same. And again, you can see we are hitting a lot against resistance in SPY. So it's an important week coming up. With all those earnings and the resistance, it's going to be a fascinating week. Actually, every week has been. I know there hasn't been any disappointment with excitement. So you can see ATR for SPDR is $10. If I went back like 4 months ago, you'll be amazed how little it was. So that tells you that's the volatility that we are working on. All right, with that in mind, what else I want to do is, so let's, now this is stock charts. Let's say you open stockcharts.com. I just want to walk you through how you can get that Keltner channel. Let me try Apple again.
So Ramin, you're not sharing that screen.
Oh, you're not seeing that?
No.
Oh, did you see the Finviz?
Oh, we see the Finviz. You just switched, and then it switched to your video. Yeah.
Oh, sorry about that. This is it. Okay, let me try stop share screen. All right, should be good to go.
Okay, here you go.
Great. So, thank you. How about now? Are we in stock charts?
Oh, good. Yeah.
All right. So I just typed in Apple. Let's go to Apple. So this is the standard, how everyone sees Apple is broken over. So standard comes with their 50 and 200-day moving average. They had RSI in momentum indicator oscillator, and they have their MACD. So let's say I want to do Keltner, right? So Keltner is inside on the top. So you can see the simple moving average is 50. The simple moving average is 200. I press the button here. What I look for Keltner channels. I press that. I say update. Now you have this through the dotted line as a 20-day simple moving average. Now this is different than Bollinger Bands for some of our advanced audience. Now Bollinger Bands works on standard deviation and it's on a volatility. So it's a lot more volatile band than Keltner. Keltner is a lot more smoother and a lot easier to understand. And basically, I will show you a technique, we call it squeeze, when we use both Bollinger and the Keltner channels together. But basically today we are using that. So let's say we had MACD, I want to add stochastics. This is the bottom and top ones. RSI is there, MACD is there. Let's add another indicator, which is we call it oscillator, and it's called stochastic. And we want to use the slow stochastics, so it gives us a better, and then we press update, it's a slower moving, and now you have it. So basically that's how you use the stock charts, and you should try for any vehicle. If you want to know the symbols, let's say, just say US dollar, it gives you, again, Bitcoin in US dollar. It gives you the ETF for the US dollar. Let's say I want to see what is crude oil. It gives you all the ETFs for the crude oil. And then if you say gold, for instance, it gives you anything that's related to gold. And, let's say this is gold. All right. Okay. My apologies. I ran a little over it. I know 3:30 we like to finish, but anyway, I'm open, Sean, if there's any questions.
Like my miracle products that I use to really.
So thank you, Ramin. Thank you for the wonderful presentation. Now I unmute everybody. So we have about 20 minutes to ask questions. I'm trying to, have every session within 2 hours, so we can post
I see this.
on the Eventbrite later on. I will send an email once it's done. So anyone with questions, you're free to ask now. Thank you.
Thank you, Sean.
Hey, Ramin, this
Yes,
is
Henry.
so if I go to Finviz to that futures
Yes. Okay, let me
page.
share that. Can you see my Finviz?
Yeah,
Okay.
yeah.
Let's
So
go
if
to
you
futures. Yes.
right. So like you were saying, I often look at this screen like a day before,
Yes.
and what I'm seeing often, like if I see VIX, for example, in green and all of the indexes are in red, I'm anticipating that there's going to be some volatility and the markets perhaps are going to be moving down. What I see often, as soon as the market opens the next day, it kind of reverses.
That's
And
Henry. That's awesome. Yes. So what happens again? These are futures markets. So when you look at it, there's about 15 minutes delay. So when you're at night, that's why you don't trade at nights. Basically, it just gives you some ideas. But these are overseas, right? So the first market's open in Australia. So they are not a very good indicator. So what you want to do, you want to be prepared. So at 6:30 in the morning,
Bacteria in the bottle and then using it again and putting the bacteria back in the face.
there it goes. 6:30 in the morning. That's when you start seeing about 5:30 really. 5:30 is an excellent time because now you have European markets open and you have New York open, the futures market, right? 6:30. So my trading goes this way. And I've mentioned it before. I don't do much from 6:30 to 7 o'clock unless I want to close it because a lot of retail investors come in. They are very news oriented. They heard something. The meat of your really trading is from 7 to 8:30. 8:30, the European markets close. That's why then you don't do a lot of Forex trading at that time, basically. So 7 to 8:30, they give you a nice, basically bracket, I call. At that time, I review. Then you know, again, that's a better indication. At nights, if you're going to be a trader, that's when you want to do. By the way, the VIX for this is sometimes it's not the best. So if you have other, sometimes they don't give you the exact, but everything else is pretty much very similar to what's happening with TradeStation or TD Ameritrade, I think, or SWM or NinjaTrader. Whatever charting tool you use, it's pretty close. So, and it's free again. But granted, so at night, you just want to be prepared. See what's going on, and in the morning basically it fades. Sometimes there's just so much. If you watch, and you can change these to the 5 minutes. The markets are closed now, but the other good thing is on the home page, you can, if you look at this gives you the 5 minute, basically tells you the short time. The last thing I will say, let me just do this S&P 500. That's another good thing right here. When you go to the major, you see there's that 5 minute or hourly. So you can actually see what is happening, like hourly, right? So overseas what is happening. And usually when this went down and then the next day we faded it. So one thing, I'm glad you asked that. So you can see these are the 3 types of futures traders. There's the commercial hedges, which are the biggest. Then you have large traders like big speculators, hedge fund managers, and then you have small traders like me. Usually we know the least, so you want to go the opposite. At least, I mean, with the retail. So large traders are the more professionals, and commercials, they usually do the opposite. So if they're long, they own something, they want to go opposite to hedge themselves. All right, good question, Henry. That's very important. So, all right, another question. We still got 15 minutes. So, any other questions?
Hi, I had one, Uncle.
Yes, Kenneth.
It's kind of a broader question, but
Sure.
remember you were talking about how oil is at a real low at the moment.
Yeah.
What could you speculate, or what do you think it's going to reach after this whole quarantine thing ends and people start using it more?
Very good question. So that's all depends. Basically, as far as the two things. So always when there's we call darkness is always light. So what I would suggest is right now, think about economies for the big consumers of oil. They're the big importers of oil, such as India, such as South Korea, Netherlands, China even. You look at the countries that, even Turkey. So they are the ones who are going to have a great bargaining power. So now with the large population, let's say in India, for instance, it is this is a fantastic time because they are big energy users. So those are I kind of focus on more on importers and the users of oil than actually thinking that what is going to happen. Because if I look, we still got so much that I would not play at this moment till I get confirmations. The problem is we will see what's going to happen with the closure of, are we going to have closure of these wells? Is the big companies going to come and buy small companies? And you have to remember, when I say deleveraging, what that means is people who had borrowed or leveraged their investments to buy, let's say, oil, eventually they have to give up. So that means there's going to be even more supply coming out because they have to sell their shares, so, or their holdings, whatever it is. So right now, I would not, I think you would be better off to play maybe with energy companies, some solid ones, than just oil itself, including the ETFs. I mean, I would not, I mean, I mentioned to you what vehicles you have, like USO or BNO or the DBOs. I would be very cautious. Don't try to be a hero. Like, you know, you could play options because it has limited risk. If you have like the money that you're afforded to lose, let's say you want to buy 200, I'm just saying, $200 option on USO for 6 months, go ahead, we'll do it. So, does that answer your question?
Yeah, no, that's good. Thank you.
You're welcome. Okay. All right, any other questions?
Ramin Hamad here.
Oh, hi, Hamad.
So I wanted to ask that sector-wise, are there some certain sectors that naturally offset each other? Meaning, if you are, more involved with one, certain other ones kind of go always, or
Great
usually
question.
go against them, so you can hedge yourself a little bit.
Yes, so that's a fantastic question. Let's look at what is the year to date. What are the best performing, right? So this is, again, Finviz. So the #1 performance in sectors have been healthcare and technology. Right there, those two, they tell you we are in a new world. So when you think about, and that goes back to the NASDAQ component. Look, what are the worst ones, Ahmad? We have basic material, financials, and industrial goods. All three of these are very much economic sensitive, right? So now you have defensive, such as healthcare and, in a sense, technology. In a sense, it's a complete different. And utilities are usually the defensive side, so they're like in between. But if you have exposure to the, if I want to see economies turning, I need to see financials to go up. So in order to do that, then you want to be in the healthcare. You want to be in the gold, maybe, just the precious metals. And so basically, I think this is a good indicator. Now, you can even do a micromanagement and say, hold on, what about industries? What about if I found something in the, as far as performance is looking at the year to date, some of the best industries that give me the best ones, the mail order, and then, you can receive gold. So you can kind of offset by using just different industries and find the best stocks in them. Is that helpful, Hamad? Does that answer your question?
It does. Can I ask a subsequent question related
Sure.
to that? So,
Okay.
for example, let's say, financial stocks have been down for a while. The whole sector is not doing too well.
Correct.
And if you look at your whole portfolio, if you assume that, maybe 30% of my portfolio right now is more focused on day trading just because there's so much volatility and opportunities come and go. So you're okay playing with that. But then for
Correct.
70%, you're long.
Correct.
Your focus is long term. So, I mean, some of the better institutions say, even if we pick financial, would be, I mean, the way I'm doing it, and I just wanted your opinion if it makes sense, that, if my horizon is long term, I am slowly starting to get into those financial stocks because I don't care if they continue to go down another 10% over next 6 months, as long as, there's a good chance that these are solid companies and, over the period of 3 years, they will be much better where they are. I mean, does that approach make
Absolutely.
some sense?
That's exactly, again, you have to sit back and say, if I'm a year from now, I look back where I was, and today I am, how the things are looking. And that's why you look at scenarios, right? Let's say the pandemics got really worse, or we open and everything is good, and then the second wave happened, what is going to be affected. So, but we look at the rolling 5 years, for instance. Really, we don't have, I mean, when there is the valuation, and this, you mentioned solid companies, I would gradually get in. But as I mentioned, again, there are a lot of new technology and new industries are going to be born. For instance, you cannot say, oh, Kodak, I'm going to gradually get into Kodak, and this is 10 years ago, because, oh, they're beaten up so badly that this is a great, or Sears, for instance, Sears is really beaten up so badly, but people still have to shop. They're going to go to the mall. So we are changing. So the banks that you use, it is a financial, do you think Goldman Sachs, how is it going to get hurt and how is it going to get earnings? What about Bank of America? And you look at, again, the real estate, what's going to happen? You have to sit down and say, in 3 months, 6 months, if people don't pay their loans, if they don't pay their mortgages, how is this going to affect the bank? So I would be selective, but I've said it before, I would gradually buy some quality companies. We've talked about, even initially we talked about Microsoft, we talked about Disney's and even Bank America of the world. You look at and say, listen, I'm happy to own Bank America at 15 or 20 or whatever price you want to put on, and 10 years, 5 years, 3 years down the road, you say, well, I did the right thing. Now, on the other hand, some economic sensitive place, how about autos? Do you want to own Ford? Do you want to own GM or Tata Motors from India? So these are the decisions you have to make. Depends on your personality, your time horizon, and it's all about risk management, right? So let's say you said, you know what, I love Bank America, but if it goes down to 25%, that's my pain threshold. I cannot sleep at nights if I put $1,000, I've lost 250. I'm just using it as an example. These are the times that you have to have a good risk management and money management. So maybe you can buy XLF, just be on the safe side and say, well, I want to buy a whole ETF and just don't have to buy the stocks, and just gradually, every week, I'm going to buy 5 shares. I just use that. So next 3 months, I just buy 4 or 5 shares, and I got a portfolio at the average. And if it went down, so much better, I bought more. If it goes up, I've been in it. So that's how you have to approach it. But again, it all depends on like your time horizon, your capital. I had mentioned it again before, I would not like to put more than 2% of my capital, risk more than 2% in any holding. So that's my risk management. So if it goes below that, let's say it's 100,000, it's $2,000 is the most I can risk on any given stock or holding. So anyway, right? But very good question. I think we're gonna do the whole session on the risk management, and then how to buy and how to sell and what to look at, and again, it all depends on your personality and time horizon. It's very important to take that into consideration. Thank you. That was a very good question.
Thank you.
All right, first.
Thank you. I think we probably have one more question.
Okay, thank you, Sean. Any one more question? All right, going once, going twice. Hello, going three. Well, I hope that in mind. I hope this was informative. Again, every week I like to come up with something that it gives you, again, the tools that you can use it on your own rather than waiting, as I mentioned, for Bloomberg to open and bring the guest. And I'm hoping by understanding the fundamentals, it might be even easier to understand what the news are, and you can do your own refining, analysis, and filtering, because there's a lot of noise out there. Just use that news about Gilead, and the world doesn't work that way. I mean, if there was a stock that was with vaccination today that they had all that, I mean, the markets will move 5,000-6,000 points on Dow. I mean, it's like if we had that certainty. So there's a lot of noise out there. Just be careful. Just be cautious. But it's a very good opportunity to make money. I mean, these are the amazing times we're in. But my wish for all of you is, first of all, to be safe and healthy, and all your loved ones, and make sure that, again, your well-being is your top priority. Your loved ones, the relationships are the absolute priority. And I think it's a good moment for us to share our love for each other. And then I'm hoping this will go away and we'll be back to our normal lives. And a lot of people are getting hurt, but hopefully we find a solution. All right, Sean, thank you so much again for your help.
Thank you.
I appreciate everyone. You have a wonderful week ahead, and I look forward to seeing everyone next Saturday.
Thank you, Ramin.
Thank
Oh,
you.
pleasure.
Ramin John. Thank you.
Thank you.
And I have to say, Ramin, this is getting better every week.
Oh, Henry, you're kind. Thank you. Thank you so much.
Seriously.
All
right.
Thank you,
Bye.
Ramin.
Thank you.
Thank you,
Bye-bye.
Najin. Thank you. Thank you, Nadajan. Bye. Bye.
You're welcome. Bye.
Bye. Bye. Bye.
Thank you,
Bye.
Ramin.